And welcome everybody that's joined the webinar today. At Kids First, we're always trying to find ways to give people information so they can be informed, making their own decisions and working through. It could be, usually is and often is a very difficult process, both legally and emotionally. So we at Kids First have really enjoyed this partnership with Town and Country so that we can really get some information out there, answer questions, challenge you to think about things if you're in this process or thinking about going through this process.
My name is Nicole Lemieux, and I am a mortgage loan officer with the credit union. Just a little background, I spent 13 years of my career with Town and Country on the branch level. So I worked very closely with our members, helping them with consumer loans, most of the time, auto loans, personal loans, consolidating debt, restructuring debt, opening new accounts, doing a lot of face-to-face interactions. And so I just recently, within the last 2 years, switched over to the mortgage side of Town and Country and have been doing the mortgage for 2 years. So I'm really happy to be here. Thank you so much for coming on. I hope what we go over today is helpful. And please feel free to ask questions at the end as well.
And hello, everyone. My name is Brittany Eaton. I am the collections manager here at Town and Country. I've been with Town and Country for almost 12 years now and doing collections for about 10 of that. So in our collections department, we really strive to help members through hardships. So budgeting, financial hurdles, things that maybe you don't think a collections department typically does. We really try and help our members the best way possible. So really happy I could be here with you today. I'm also actually on the Kids First board, so I was excited that I was able to be a presenter here today. So to start off, we're just going to talk a little bit about Town and Country and who we are. So at Town and Country, we've been helping people since 1953. We currently have 40,000 members, and we serve Cumberland and York counties. We also have we have 6 total branches located in Portland, South Portland, Scarborough, and Saco. So as Linda had mentioned, today we're gonna go over financial impact of separation and divorce, and thinking about big life events. When they happen, they can really impact your life in certain ways, and especially there can be a huge impact on your finances. So when you're looking at the screen, you may already be in the midst of this stuff or not even thought about any of this financial impact. But some of these things we talk with members a lot is you may be dealing with a reduced income when you're going through a separation or thinking about a separation or in the middle of divorce. You are a 2-income household and now maybe you're down to 2. There may be you feeling like you're having to dip into your savings more, so that's reducing your savings, or unable to secure your financial future because you've had to dip into a 401k just to get by and deal with the separation. And added debt to unexpected expenses that maybe you had never had to pay for before because your other partner was paying for them. And with that, there could be an impact on your credit score. Sometimes life happens with different things, and with this, you could get behind on some payments. So there could be an impact on your credit score. So looking at all these, if you feel like you have experienced them or you are experiencing any of these, we're really here to help you today to navigate through that and be hopefully a really good resource for you.
So when we talk about protecting your money, one of the things that we talk a lot about with members and non-members that are going through divorce or thinking about going through a divorce is the start of uncoupling accounts. So this can be a little bit daunting if you have a lot of accounts together with your partner. So I think one of the first strategies in starting this process of separating checking, savings, and investment accounts is to write down somewhere all of the accounts that you currently have together and also alone. That way, when you start looking at what needs to be the next step, you know sort of where to start. And so uncoupling your accounts, stocks and bonds, retirement savings, and college funds kind of goes under the investment piece of this. But to start with checking and savings, that's really important. And I think as part of separating it, the first step is also to establish your own individual account. So you could go into your institution where you have, your account with your partner or another institution and open up a personal checking and savings to get that piece started. And so that way, when you need to start closing the accounts that are together, you have a place to put that money that might be split or however that's going to work for you. So I think opening up a personal account is the first step. And then writing down all the accounts that you might have jointly is the second step in sort of figuring out that process of separating your accounts. Along with separating accounts, you're going to want to update personal information. So this could be your wills, trust, power of attorney. When separating, you may have a will or in a trust with your significant other currently. So you're going to want to try to figure out a way to then do your own will, trust, and power of attorney if possible. This way you're protecting yourself. If there's children involved, you're protecting them as well. Updating beneficiaries. So this could be your life insurance policies, your retirement accounts. You can update those typically with whoever they're currently with through your employer, or if you have a separate life insurance policy, you can go in and you can update who you want for your primary beneficiary, and then you can do your contingents. So just updating all that information is important. And then real estate titles, this one's a little bit more in detail. So this would really come down to whether you have a property together. When you decide on what's going to happen with that property, whether you're going to sell it or if you're going to keep the property and refinance it in your own name, that's really where this piece would come in, updating the deed of that property into just your name. And then, of course, if a name change is part of the divorce, you can do that through Social Security, typically through their office. And then account passwords is important as well. So if you're keeping an account, changing passwords or just updating those is important in this process. And then once you have established a personal account, you can then switch a direct deposit. So if you're going to open up your own account at that time, you can switch your direct deposit to then go into that account instead of the joint account. So updating all of that information is important to keep in mind as well.
And dividing and managing debt is a kind of a hurdle that many members experience because it can be a lot. So in my department, in the collections department, we work with members a lot with this when it comes to dealing with the joint debt. You have credit cards, auto, personal loans, home loans with someone you're going through a separation and you just don't really know where to start. So many times we're working with the members, we really try and tell them, if possible, to work together to achieve the best result. So working with your financial institution or your mortgage lender, but also trying to work together. Sometimes that's not the case, and we've dealt with that too. But it helps if we're able to speak with both of you together and work through this is figure out, okay, what can we do? Something else that we also talk a lot about is the divorce decree that you would be getting to say who is responsible for what debt, knowing that we have a lot of members that come to us and say, it is in writing that I do not owe for this auto loan anymore, so I'm not going to pay. But keeping in mind that it does still mean you're obligated to pay the debt until, if you are the person, until you put that in your own name or the other person puts in their own name, until that's done. Like in my world, we would still make the collection calls, the past due notices, you are still legally obligated to pay that. So keeping that in mind, sometimes it's just not explained. we're here to help you through that. So we could help you look to see if you qualify to put that in your own name for credit cards, auto, personal loan, real estate loans. Or you may have to make some tough decisions when separating that debt. If stuff cannot be decided on who gets the car or who's going to pay on the credit cards. We talk to members sometimes about, is it we need to sell the vehicle and we can work with you, or a repo, or sometimes even bankruptcy if refinancing or removing someone from debt. We work with a lot of members that it's really the last thing that's available to them. So it's okay. That's a decision that it helps a lot of members. If it's a lot of unsecured debt, a lot of joint unsecured debt, you can file bankruptcy, speak to an attorney about that. Many attorneys, you can sit with them and talk to them and just figure out what's best. And they're not going to charge you the first meeting. So just figuring that out may be an option. It can be scary, but sometimes it's really the only option to really divide and manage that. And then with the mortgage, I think Nicole may jump in if I'm missing anything, but with the house, really trying to weigh the options. Is the house underwater? Can you realistically afford on one income? And like, what's the market looking like right now? Could you buy that person out? Real estate loans can be tougher than the autos, the credit cards, the personal loans. There's different options there for sure. Maintaining your credit score. So with all that being said, there's a lot that you have to think about. And so trying to be proactive and protect your credit, it may not be front of mind for you, but it really should be if you are trying to separate your debt, get back on track. Maybe you did have some late payments going through this separation. Being proactive, monitoring your credit. We have a great resource on Town & Country website. If you are a member, Savvy Money, you can check your credit report, or freecreditreport.com is another great resource, just monitoring your credit activity. So if you went behind on a loan because of an unexpected bill or an attorney bill that you had to pay and you couldn't pay a flex loan, making sure you're monitoring that and clearing it up. Or maybe you thought your ex-partner was paying on a loan that you're joint on and they didn't. Being aware of that is important, and just calling your creditors to discuss. As a financial institution, we're really here to help you. Communication is key. We say that a lot to our members. We have many members that call before they've even filed for divorce, say, okay, what do I need to do? Because it's stressful. So we are here to help you. We're not here to judge. And we're going to try and help you in the best way possible and work with both of you. So really just trying to call your creditors to discuss what options you have. You may be surprised of what there is that we can help you with. Living and paying the bills. We're going to talk about some 3 key savings that you want to build. So building your budget. Up on the screen here, we have some budget items. Mortgage and housing, 30 to 40%. Transportation, 10 to 15%. So trying to figure out your short-term, emergency, and retirement with budgeting is important. So adjusting your expenses according to your income. So now looking at what are your priority needs versus your wants. That may be different from what it was a couple months ago, a couple days ago. So trying to look at that and analyzing your spending habits is also something that is good to do, and monitoring and adjust. So you may sit down and do your budget today, and maybe in a couple months that changes because of a change in job, a change in bills, a change in priorities. So sitting down, monitoring that, adjusting that is really important. And keeping an eye on your monthly statements helps that too. Monitoring your spending, what are you spending on that maybe you could cut or change. We also have a great financial resource page on our Town & Country website that has a budget fillable form. We sit down and help members all the time doing budgets when they do have a life-changing experience like this and they are going from 2 incomes to 1, or they have an added childcare expense that they didn't have to pay for. Whatever it may be, we can help you with that. And then you could really look at your targets. Okay, what am I spending on transportation? Can I get that to 10 to 15%? Because maybe you're paying more than that. And then the last thing was just some resources we have for you. Our website, like I've mentioned a few times, really great resource. We have a financial wellness resource page. Our money management and Savvy Money is if you are a member at Town and Country, that's available to you. Also great to help you with budgeting. Annualcreditreport.com, freecreditreport.com. Some questions that you may have or had today may be best to even ask for a personal financial planner, accountant, an attorney, or your preferred financial institution. We're definitely happy to answer questions that we can, but there may be some that are best for a personal financial planner or a accountant. Nicole and my information is up on the screen. Nicole is a great resource for mortgage. You have housing questions or any other questions, and then my email as well is up there. So feel free to reach out with any questions you may have, and we can direct you to someone if we can't answer the question.
This really depends on what makes the most sense financially. So some people will leverage their 401k to make that payout. And in today's market, the rates, as most of us know, are a little bit on the higher side, but the home equity line of credit is a good option still, as long as the monthly payment is something that can be afforded. So I always suggest to do the HELOC before the 401k, just because I don't think necessarily taking money from retirement is the first option, unless it's the only option. The HELOC is a great option. The payments can be a little bit on the higher side depending on, the amount, and then the rate is variable and things like that. There are some factors with that. But I think the HELOC is the first option to explore in this sort of situation before doing anything with the 401k. And there's other options within home equities. There's fixed rate variables with terms. There's, line of credits, which, typically are what people will do when doing a buyout until the rates come down, and then they may, refinance the whole balance into one mortgage. But there's many options as far as taking the equity and paying it out. So I think exploring the mortgage side first before doing anything with a retirement account is best option.
You're going through a divorce process, what the court generally does, and when I say the court, it's mostly the parties working together, whether they have attorneys or not, the court, they're looking for to basically see what we call it, what's in the marital estate. So that's all the stuff. So when the suggestion of making a list of all the accounts in your name and your partner's name, that's a great suggestion, because you don't know how things get divided until you know what there is to divide. So that's really the task. And if people work together to create that list, you can save a lot of money and legal fees and time. But this question really goes to how does property and money get split by a court, as opposed to how the bank physically or the credit union would physically help you. The question goes to what's a court do? So Maine is what's called an equitable property state, and that generally means that the marital estate is divided equally, but it doesn't have to be. So ultimately the court would need to decide whether there's some reason why it should be split other than 50-50. But let's talk about the usual case where it's split 50-50, where this question goes to. It's perfectly proper if by agreement you guys decide that you're going to split that check in two. If you were coming into my office or you were going into the court, any attorney would probably say, hold off before you do anything with it. Put it somewhere, put it in the bank. But what you really want to do is look at the bigger picture. So it could be that, this 401k has been split 50-50, but you may end up owing your partner some money, or that person may owe you money. And this would be some money to make that happen. So what I would suggest is you don't do things piecemeal. You look at the bigger picture, because that's how the court does it. It doesn't look at individual things. It looks at the bigger picture. What's in this pie? And then how do we divide it in a way that's fair and that is meaningful to both parties? So it could be that someone might have family money that's not within the marital estate, and their cash strong, where the other partner may not be, so the cash may go to the other partner. So my suggestion would be 50-50 is great. And if you guys agree, and you can do anything by agreement. It's when you don't agree, that's when things get a little hairy. And so I would work the bigger picture before, and just kind of set it aside and see where it fits into the bigger picture. There was a second question that was very similar. I just want to make sure that, the question about investments and whether they get divided. That Maine is, like I said, an equitable property state. Any property that's acquired during the marriage is considered assets of the estate, whether both names are on it or not. So this is where it get a ton of questions. It's very tricky. It's like, well, I have this savings account that I've contributed to from day one of our marriage, but her name is not on it. She doesn't get it, right? Not necessarily. So it's still property of the estate. So, Tanya, I would love to provide consultations, but I'm no longer in active practice of law. Kids First can give you some referrals for attorneys, but unfortunately, I'm not doing that at this point.
Also too, just to add to that, Angela earlier on mentioned that with dealing with debt and dealing with these kinds of things, sometimes working with a mediator can help work through some of the disagreements and to get to a mutually acceptable approach for dividing and dealing with assets and debt and all that might sometimes be more affordable to everyone than legal fees. So a mediator is an option too to help with the process.
That's such a great point. And in Maine, unlike other states, if you don't have an agreement with your partner, mediation is required. The court has a mediation service, which is very good. A bargain as far as any legal process. The fees for mediation are extremely low in the state of Maine. It will put a plug in that there is a new service out of the University of Maine at Augusta for free mediation for people going through divorce. And if you reach out to the Kids First Center, send me an email, give us a shout on the phone, and we can connect you with that resource if you have any interest in availing yourselves of that. Assets, even if your name is not on it, if it was acquired during the marriage, is considered part of the marital estate. Same with liabilities. So even if your name is not on it, it was acquired during the marriage, that liability also is part of the marital estate. So this is then when things get the court And that court process ends up looking deeper into, what was that debt incurred for? Was it incurred to buy things for the household? Was it used for something totally outside of the marriage? So there are some things that can be scrutinized, but the general rule of thumb is both assets and liabilities are part of that marital pie, and how they get divided up is really where a lot of the work is done through mediation. That's what the attorney's jobs, if you have an attorney. If you don't have an attorney, that mediation process, we'll spend a lot of time working through that. So number one, as Nicole, I think Nicole said, maybe it was Brittany, but taking an inventory of all of it is key to saving a lot of time and money in the legal process.
So houses are more expensive, which means payouts can be more expensive. And so what we're seeing a lot of is people are opting to sell rather than even consider one party keeping the home, because you're getting a larger payout. You're getting more money for selling the home because the market is so high, and that home that you may have bought, I don't know, 10 years ago for 200,000 is now worth double that. So you're getting more money to then either buy your own place, or a lot of people are renting, and rents are high too, but they're not ready to settle on buying something at the time now too, because the market's high. So you're selling high, but you're also buying high. So that's tricky. I think one of the other things that I'm seeing quite frequently is people that have the resource of living with a family member, they're opting to do that now. So they might sell the home and then live with their, folks that are older, or a brother or a sister that might have an extra bedroom. Like, there's a lot of creativity going on right now because the market is so challenging. And also I think, and Tim probably can say something to this, but I think there's a new sort of, I don't know if there's a technical term for it or not, but it's like where there's an arrangement where the parents actually are the ones moving instead of the children. So, before it would be the children would move from mom, the arrangement, say a couple days, and then go to dad's house. And now it seems as though it's the parents. So they're keeping the home for the children, perhaps if there are children involved. And then they're the ones moving because it's really not an ideal situation to sell the home with nowhere to go. So it is challenging right now. I think the market hopefully will, if I had a crystal ball, I'd like to say that it's going to, improve over time. But I think people are getting more creative, and you're seeing more people selling the homes rather than, one parent or one person trying to stay in the home because they're getting, a lot for that property that they may have bought 10 years ago or so. So that is definitely a challenge right now, for sure.
Mm-hmm.
Yeah, Nicole, it does have a name, actually. The where kids kind of stay put and the parents go. We call it nesting.
Yes. Okay. Yeah.
So it's yeah. So people are becoming very creative in how they care for their children in this economy. And some aspects, it's just booming. But it does create some problems when you're trying to separate into two households. Nicole, I'm not sure if you're actually seeing this, but I know that there is litigation all the way up to the Maine Supreme Court. I don't know how it's going to come out, but the market is so volatile, and increases in value are so quick that, say you have an agreement that you're going to buy your partner out for X number of dollars on January 1st, but it takes 3, 4, 5, 6 months to get through the process. By the time the process is completed, the value of that house has increased significantly enough and sufficiently enough that you have to revisit what's fair.
Yeah.
And some of these house values are actually quite crazy. And it kind of goes to one of the questions about the pros and cons of buying out. If you can afford it and you can get real estate, but know that you're buying high. And at some point this bubble may burst. And so finding you may qualify for a buyout, a refinance of some sort on April 10th. And then you find you don't have enough money when you finish up your case on July 30th. So
Yeah.
it's tough out there because the housing crunch. If there are more houses available, you wouldn't be seeing this, but this housing stock is just not available.
Yeah, and the rates are, they're fluctuating up and down. So that's the other piece is, to your point, you may start this process, say January 1st, the rate could be X, and then by the time it's completed, the rate could be higher. So hopefully lower. But that's another piece that has to be factored in as well is the affordability of being able to buy somebody out. The equity is what you're buying out. So you're buying out basically what that property is worth, or what you agree on, of course. But and so you have to be able to afford that. And then you also have to be able to afford, some people have lower rates because they've refied in the last couple of years. So you might have, say, a 3% interest rate, and now it's 6.5. So you have to be able to afford that difference too, which has been really challenging as well. And especially when you're going from 2 incomes to 1. So it's a lot of budgeting. It's a lot of sort of getting really creative with finances. And I think the first step is always to see, what do I have for debts? What do I have for accounts? What do I have for assets? You've got to know, all that information so that when you try to do the buyout or whatever that process looks like for you, you can make sure you can afford that payment at the end of the day. Because it can be a little tricky in the market we're in right now, but hopefully for some improvements.
Yeah, and things do go in cycles.
Yeah.
There was a point, certainly at the housing crash, where nobody wanted the house. It's like you couldn't give them away.
Yeah.
And now it's just the opposite. So hopefully this will pass.
Yeah.
But it makes getting divorced a bit more challenging. But there are ways, if you bring it back to the kids, people are getting really creative.
Yeah.
Like Nicole said, they're nesting, they're finding ways to take care of their kiddos with the least amount of disruption in their lives, which is superimposed on all of this. If you have kids, how do you manage all this, the technicalities of all this, with the reality of taking care of your kids? Unfortunately, it's not an uncommon situation, but it's way too common. But again, superimposing on all of this discussion is timing. When do you do all this? And in fact, that's one of the most common questions that, Linda, I think we've had when we've done this presentation is timing. And so certainly rules of thumb by agreement. You can do a lot by agreement. And if everyone's transparent, working together, that is obviously the best. What this questioner is suggesting is we're not in agreement. We're not doing one of us may be independently acting and not in our best interest. So not a whole lot that can be done especially if your name is not on the account, because again, what Nicole and Brittany are dealing with is we have to do what's on the names on the account, and if my name is on the account, I get to drain it if I want to. So ultimately, the best solution is to have something filed in court, and then the court has jurisdiction over all the assets. And so that's where stops can be put on. There is an immediate injunction upon the filing of a divorce that is essentially stops anybody from drawing down accounts. And now, again, if they do it, they may run into some problems with a judge, and most likely will need to replace it. But having the court having jurisdiction over the estate is key. Otherwise, people, if his name or your name is on it, there's nothing that you go to Nicole and says, I want to clean up my bank account, and she looks up the account and yours is the only name on it. She doesn't have a choice, even if you say, I'm taking this and I don't want my wife to get it. She doesn't have a whole lot of choice if that wife's name is not on that account. Not sure if that answers your question, but getting the court having jurisdiction over those funds is pretty critical. One caveat to taking the inventory, take it as it is today, but also look back to see if there has been any rating of accounts and paying down debt or new debt incurred. That's all kind of part of the global pitch that you want to be looking at.